Hey, good morning, Carl. Thank you, and thank you to Mike Arougheti, the CEO of Ares, who is joining us now. So your shares are up more than 60% over the last year, in part because higher for longer interest rates have served as a tailwind for your business. But I'm curious, just kind of as a level set, how are borrowers absorbing those higher rates right now? Have you seen any kind of degradation on that front?
No, I think the worst is behind us, and the worst really wasn't that bad. So if you look at our recently reported credit performance, non-accruals and defaults are near all-time lows, well below historical averages. So EBITDA on the portfolios have been growing in the high single-digit range. So interest coverage has come down. Needless to say, when rates are this high for this long, it can cause some stresses. But now that we're likely at or near peak rates, I think the worst is behind us, so people are navigating.
What about if we kind of pull out real estate in particular? Over the last few weeks, we've seen pockets of stress in the banking sector, specifically the regional banking sector, especially those with exposure to office and rent-stabilized buildings here on the East Coast. Are you seeing the same kind of stress within real estate, or do you think it's more idiosyncratic?
In certain pockets. So obviously real estate is a pretty big addressable market around the globe and in the U.S. Different geographies, different cities are having different experiences. As an example, here in Miami, the office market is booming. And it's telling a much different story than what we're seeing in New York or Chicago or San Francisco. So I think if you zoom out and look at the commercial real estate market generally, you have multifamily is continuing to perform well, industrial, data centers, student housing, so a lot of fundamental strength in certain corners. And the office story is the office story. And obviously some of those stresses will play through the market. You're seeing it on bank balance sheets. You're beginning to see it in the mortgage REIT sector. And I think that's going to be the story for the next couple of years. It takes a really long time to resolve some of them.
So as a deal maker, are you avoiding those entirely, or are you seeing opportunity there as kind of valuations reset and, whether it be a bank or a landlord or someone else is trying to offload those properties? Is that opportunity for you?
Yeah, I think it's opportunity, but we're being cautious. So I highlight a couple things. In our alternative credit business, we've been pretty public in how we've been partnering with some of the regional and super regional banks to help navigate some of the challenges on the balance sheet, both real estate and consumer. And we recently actually announced a joint venture with a large New York real estate partner to begin to opportunistically invest back into the office space. So I think whenever you have crisis, you see opportunity, but this is one where I think you're going to have to be pretty measured before you go back all in.
There's this narrative out there that, it's a zero-sum game, and you've got the traditional banking sector, and you've got the shadow banks or private credit. And recently the Fed put out a statistic that the amount that the traditional banking sector was lending to the shadow banks surpassed $1 trillion, which kind of speaks to just the interplay that these two areas have with one another. But it's also attracted some more regulatory attention than may have otherwise been focused on kind of the non-bank, non-deposit taking lenders. What do you make of that, and what's your expectation on the regulatory front as it pertains to direct lending and private credit?
I think, again, we could talk for hours about this, because if you look at the FSOC report and how the regulatory bodies are thinking about non-bank lending, direct lending is a very, very small piece of that, and probably one that is getting the least amount of scrutiny relative to other parts of the non-bank financial intermediary landscape. So I think it's important that when we talk about non-banks, we isolate direct lending from some of the other non-bank financial intermediaries. But you raise a good point. We've been quite vocal about this. Our most important partners, or some of them, are the large banks. We've been growing our business symbiotically with them. Both they lend to us, we borrow from them, we issue bonds and equity and have CLOs. So there's this very deep entanglement. So I do think that this story of the zero-sum game and the banks and the non-banks competing is a bit overblown. Our success is their success and vice versa. And if you look at the current market environment, the liquid markets are healing rapidly. The banks are active again. And that's actually good. We're seeing increased transaction volumes. We're partnering with them on a number of situations, and I think that there's plenty enough, for everybody. So we're Couldn't be happier for them, and it's obviously good for our business too.
You have about $110 billion of capital to deploy. You put a near record amount to work in the fourth quarter, $24 billion. I'm curious what the opportunity set looks like right now and your expectation, because I know sponsor-backed deals, leveraged buyouts are a big part of your financing opportunities. So do you expect that to be more significant as we
That's funny.
make our way through 2024?
As we've gotten larger, you say $110 billion to invest, and it sounds like a huge amount of capital. We put out over $80 billion last year, and that's been in and around what our activity levels are. So as large of a pool of capital as that is, that's a year to 2 years of investment capacity. So we're obviously continuing to raise, given the attractiveness of the vintage. I would say for the first time in our history and through multiple cycles, I would characterize the opportunity set broadly the same, which is you have a lot of installed base of assets and companies that are performing well with good ownership, good sponsorship, but are struggling with a higher cost of capital. And how that gets resolved is the investment opportunity for us. So that could take the form of rescue loans, secondaries, both GP-led and LP-led, structured equity, repositioning some of these office buildings we were talking about. So the interesting thing about this cycle is we're not seeing fundamental deterioration in performance. We're actually seeing really, really high quality assets that are performing that just need to get to the new cost of capital realities.